Hey, good afternoon, everybody. Welcome to 12-Minute Trading. My name's Doc Severson. I'm joined by David Lukas here. Today is Monday, the 30th of October. Watch out for Halloween, everybody out there. We got some scary times in the market, scary times in the neighborhoods. But we are going to talk about that today as to whether or not is this the reappearance of the bear, or is this just a pullback in a larger bull market? We'll definitely discuss that. Dave, what are you seeing out there in the markets these days?
This is the week in my eyes. I told my students this weekend that, been saying for 2 weeks that I thought it may come down to the Fed week with payrolls and everything in that same week. And it seems to be shaping up that way. The way that the charts have moved, we've got an exhaustion on the daily chart, which you'll show here in a little bit, which is typically a point where you see markets bottom turn around. And at the same time, we've got some interesting things happening on the weekly chart across the board. We've got, energy getting into exhaustion on the SPX, which again is another kind of bottoming sign, right? But on the NASDAQ, it's still fully charged. And it seems like the NASDAQ it's burned out its daily energy, kind of come down to a point where you get outside the Bollinger Bands, you snap back in, and that's what we're seeing today. It's what I told students over the weekend. Don't be surprised to see a bounce this week. We're just at that point. Even if we're going to go lower, we've just gone 10, 12% down. It's a good place to get a nice little bounce, even a couple percent up. And then if you want to roll back over, you can, but it also can be that point where we stage that bottom. And then we go on that kind of fourth quarter rally that we seem to, have most years, right? And this is kind of set up perfect for it because all the big players, the hedge funds and everybody else are at their lowest positions in, equities that they've been in all year. You've got everybody doom and gloom, and it's this thing's going to just fall right over, economy this and mortgage rates that and rates this and everything. So usually market will do the exact opposite of what everybody expects it to do. And so wouldn't be surprised to see a rip and rally come out of this, and it could come due to maybe the Fed being a little bit dovish. Could be coming from payrolls being less, so we'll see. That's why this, I think, is that week, and it's going to either cement whether we go lower from here or we are going to turn around and have that rebound and get that run higher. So patience is key this week.
It's funny you mentioned that because as I think back in all the years we've been around the market, it always seems to follow that. If you remember, maybe 10 years ago, I think it was the end of 2012. Where everybody was convinced that we were toast, right? So we had the sequester, we had the fiscal cliff. I'm sure you're starting to remember some of these terms, and right. Just like everything was really bad. And we were just coming off the bottom of the great financial crisis. And it was very tenuous, right? We had a couple of corrections on the way and things were just sort of dicey there. And 2012 by itself, I think, if I recall correctly, the beginning price of the S&P and the ending price were literally about the same.
Almost the same. Yeah.
I think we went flat for an entire year. And so we get into the end of that year and very similar type of backdrop in terms of just very negative, very, everybody convinced, everybody starting to dig themselves a bunker in their backyard. And what happened in 2013? We had something like a 35% rally. Look out of nowhere.
Last year. Look at last year. Yeah. Last year, what happened in October? We put in the whole bottom for the bear to that point, and everybody thought it was going to continue. Or what was it? SPX 3000 was coming, right, and everything. And I think we hit like 3,600, and then bam, it kicked off from there. Really cemented itself all the way into December, and then that's what plowed into this year, and then kept on going back up. So just I wouldn't be surprised to see it. We do have a lot of fundamentally bad things, challenging things that are out there, but we just printed 4.9% GDP. Now, if you dig into the number, there's a lot of things that make that 4.9% that aren't so much the private economy, more the public sector, but still 4.9% GDP. I don't know. It's one of those things that you're not going into a recession anytime soon, right? With that type of number, right?
Well, so at least,
yeah.
Yeah, the official
go through another couple quarters yet.
The official recession, but we had an official recession at the beginning of 2022. We had two different quarters, two separate consecutive quarters of negative GDP growth.
And they did well. But they changed the definition.
They changed the definition. So kick the can down the road. Make sure it sticks to somebody else.
But listen, look at this though. Here's the crazier thing, right? And this is what I don't know how Powell and them they know this. They know this. I think there's hope. I think there's hope that it naturally resolves itself through some other means. We just added $600 billion in debt in 1 month. At that pace, that's $7 trillion over 12 months, over $7 trillion. That puts us at over $40 trillion in debt by this time next year. And already we're spending almost $1 trillion on our interests. Can you imagine where we'll be a year from now if they keep this pace up? And there's nothing that's signaling from, we have a current administration for at least another year. There's nothing signaling that they're going to change their tune to this. So one of the big things to watch this week is the Treasury's got to put out their issuance of what they need to do to fund things in the coming quarter and all that stuff. That's actually happening, I think, a couple hours before the Fed on Wednesday. So that's something to watch this week to see how the market reacts to that, because I don't see how Powell and them realistically, unless they really want to collapse the financial system as a whole, can really keep jacking rates into this while this is happening. So I think they're hoping that there's some fiscal sanity that comes in and starts to resolve itself on its own. But I mean, that's like, you got $2+ trillion deficits. You realize just to start making a dent in this thing, you need to cut $3 trillion a year in spending so you can start paying $1 trillion back towards the debt, right? And paying it down. We know that's not going to happen. So we're going to run deficits. It's just how big. So I think I think the Fed is at that point where they're like, okay, fine. Inflation needs to just be higher. And that's the way it's going to be, because I don't think they can continue going and really, I don't think they want to crash the financial system. And I don't think their board members, which are all the banks and everybody else, want to go along with them over that cliff,
Yeah, so. to get to 2% inflation, I think that may be a realistic goal for the old ways of doing things. And I don't know if it's in this new normal where we spend money like a drunken sailor. So Powell's got to feel like he's at the end of the parade with a dust broom and a mop and, a dustpan and stuff like that.
He doesn't have the guts to say, stop spending money, you idiots. I mean, that's really what needs to be said. Congress, this is your problem. You continue to make this worse because you keep spending money like idiots. Like if we had a strong Fed president, that's what they would be saying. That's the stuff that Volcker said, right? I mean, and then it brought everything in line. It took, and then he jacked rates to do it. So that's the nobody wants pain, right? We talk a lot about this. The human mind and brain is does everything to avoid pain and seek pleasure, right? So, nobody wants to be that one that bear the bad news. But so I think he might come off a little more dovish this week, though, because I just don't think they can continue to raise at the clip they've been doing.
Well, what I'm going to do here is I'm going to hijack our session. I'm going to run it over to the charts so what Dave and I have talked about is the optimism for, seeing some type of rally, which gets us into the fourth quarter. Maybe this is optimistic of hitting 4,600 or anything like that, but who knows? You just never know what's going to happen for this. But let me take the opposite side of the coin. What would have to happen for this truly to run into a bear? And I think what keeps us, what allows us to sleep at night is the fact that we look at both of these sides literally every day. Like, what's going to have to happen for this to crash? What's going to have to happen for this to rally? So we're not completely tilted on one side or the other. We're flexible with this. The problem here is that if you go out to like a quarterly chart, if I turn these candles into quarterlies, this is showing a lower high setting up here, which is potentially a big reversal. This could be a big trap. But what we have always seen is the price doesn't just fall off the cliff like this. It never happens, unless we're going to have a pandemic or something like that. This is the only time that I can recall where we had an exogenous event to that degree other than 9/11, where the price just fell off the top. So price works by moving what we call rule number 2 of fractal energy trading, reversals start from the inside out. So if we get this bounce up over the next week, okay, great. That's, check. But what happens after that? So one of two things can happen. Either we can see the price, drop again like this, or we can start to see the price maybe put in a higher low and then start to drive higher. So if we see that reversal at the daily chart, that tells us that, yeah, maybe we got a shot to hit 4,400, maybe 4,600 by the end of the year, something like that. Obviously we're going to have to break above descending trend lines. It's never going to be an easy shot to do that. But what happens here, I'd say within the next week or so, based on this rally and then the next pullback, will tell us a lot as to whether or not we're going to be heading higher or heading lower into the end of the year. Now, I will say that if we do end lower, there's still a happy ending for this if we end up doing something like this. And if we do a double bottom undercut, so if we slightly undercut that level and then close above there at the end of the day, that forms normally a really powerful trap. And we could see a V bottom kick in off of that. So what happens here in the next 2 weeks, Dave, I think is going to set the tone for the end of the year and how we start out 2024, whether or not we start to work ourselves down from here or whether we seize the uptrend. Remember, this is still an uptrend. We still have an uptrend in place here at the monthly chart, at the quarterly chart, annual, whatever you want to call it. And those don't give up that easily.
You've got bull flags on the larger time frames. I mean, those are traditional bull flags that you have set up on those larger time frames. So, I mean, to go up like a case like the NASDAQ 30+%, giving up 10% of that on a pullback is not a big deal.
Yeah, NASDAQ actually looks really good. I mean, this is
it's the leader.
This is a traditional bull flag. It's only down 9% or so. This is a, and I was wondering, I looked at this as well too, because I was like, man, I can't remember the last time that we had, I'm going to pull this back to a monthly chart, and I'm going to go even further back in time here. Past 20 years, I'm going to go max available on this dude. But what I've wondered about is like, have we run into corrections before like this so soon after the bull? Because we just escaped the bull. We just escaped the bear back in June. We finally transitioned out of the bear back in June into a bull. And now here we are giving it all back again. Well, guess what? I found out the same thing happened back here in 2010, 2011, in 2012, here's that flat year that we talked about, and this is what happened from it. So this is very, very common for a market which has just gone through pain, death, and destruction, rallies out of it, and then all of a sudden comes back again. If you think about it, the same thing happened back here in the fall of 2020. We just rally out of the pandemic, we hit new highs, and the next thing you know, we have a back-to-back 10% correction.
Look at that. That consolidation. Look at the consolidation around 4,000 on this chart. I mean, look at that right now. Like if you just where we've kind of pulled back right above, look at that consolidation that's in there. That is a massive confluence of price action over the course of months that's just sat there. So that's a hell of a level of support.
Yeah. Now, if I were to pull up, I don't really like the tools on this Thinkorswim when it comes to volume profile. I usually use TradingView, but if I were to pull up TradingView, we'd see a massive node of support there at 4,000 as you speak. And so those don't actually go through very quickly. What you find is that areas where we have, just one-way moves like this, they don't really create support. Where we have massive moves like that, they don't create support. And so a lot of times you got to go down and retest to the last consolidation, which was that September and October level right there at 3,600. But this is a massive, to your point, this is a massive volume, point of control right around in here in the middle of that, right, maybe around 3,900 or so, which is going to be, it's going to be incredibly difficult to get through that on the first try. So I think we do have some support, and I do expect to see price bounce from here. Now, as to whether or not it bounces into the end of the year, we don't know yet. We don't know, and that's why we're going to we owe it to you guys that are out there. And by the way, if there's any questions, please let us know. We love to address questions live for these while you guys are here. Otherwise, if you're watching this on a replay, go ahead and email us any questions that you have. We just got one in from International Pet Sitter for you, Dave.
November 3rd rut trade. I don't have a November 3rd. I've got a November 10th now because I had rolled that last week. So, but right now, and I just answered this actually in the community the other day over the weekend. I had somebody ask me about this. You don't want to widen and roll down into a downtrend, because all you're doing is putting more capital at risk into essentially kind of like a falling knife, right? So I'm looking for the Russell, which should be bottoming in this area. It has definitely led the way down, and it typically does. The Russell typically moves ahead of the rest of the market. And so what I've been looking at is this lower 1600s, 1640 area to find that support and bounce from. And then if we do rally out of this over the next few weeks, that thing's going to start going up again. And I'm going to continue to do what I've been doing, which is where I've got, it's a little 5-wide spread. It's, small contract, little 5-wide spread. So I'm not going to put too much into it. I'm just going to continue to, keep it at the same levels, roll it, sell a call spread to pay for it, and let that thing come back to it. And when I do really see a good sustained uptrend where it's going to keep going past there, and it's close, like within 4 to 5 days of expiration, that's when I pull that trigger. I widen, I roll down, 100 plus points out of the way and let that thing run away from it. I just don't want to do it into a downtrend. So this thing needs to prove itself. I want to see it get back over 1700, which, it's at like 1640, 50 today. So I think if we see it get back over 1700 and continuing that way, that's when I make my move, which is why I just kind of push it out a week or so at a time and just let it, just let it get paid for with a call spread and just go from there. No reason to put more capital into that right now. So, but should be able to work our way out of that probably within the next 3 to 4 weeks for a profit. I've got a lot of credit on that too. So 3 times the credit I normally get on that trade.
The Russell is just one of the worst looking charts I've seen in a long time. This is a great big bear flag or descending triangle, depending on how you look at it. And we've definitely released to the downside, although
it's exhausted on the energies.
Although keep in mind that what is not as important as the pattern is the price levels here, and it is actually keeping that support. So now we're getting a question
it's right there on it.
It is right there. So now we're getting a question on TLT.
This would be the level.
So TLT, which is going to be, essentially is the inverse to what we've all been watching, which is the yield on the 10-year note. And so Elaine has retracted his message, but basically, everybody's trying to figure this one out. Everybody's trying to figure out whether the 10-year note yield is going to continue going higher or whether the yield is going to start to drop because, again, remember, the bond market is smarter than the Fed. So a lot of times we'll see it move in advance of the Fed and not necessarily after what the Fed says. Sometimes we'll see a little bit of that. But right now, what the bond market is trying to figure out is, are future prospects worse or better than they are right now? And so, this is why we look at things like this in the yield curve and everything like that. So
I think we may be topping out on the shorter end of the curve because that really is dictated by the Fed raising rates. And I think they're going to pause again. And I think we actually they may be done in all respects, but it's the long end of the curve the Fed doesn't really have the control over. And that's where I think we could see the long end of the curve continue to go higher. Because if you look at what we just talked about, we could be at 40 trillion in debt this time next year. You want to give the United States your money for 10 years at 5% and lock it up for 10 years at 5% with 40 trillion in debt? Not me. I'd want a better return than that, right? And that's what's driving that long end of the curve. It's kind of supply and demand. Now, what could happen is a very, very scary thing can happen in the world, and that would drive people to safety, which would drive them to buy the 10 years and everything else, and that would bring down the rate. because it's inverse, right? If you pile into treasuries, the rate's going to come down. And so, there would need to be something, very, very scary that comes about. The conflicts that are happening now are all priced in, right? So it would have to be something bigger, something where the United States is involved in a bigger war, I would think, to get people to go flight to safety. And then you'd see the market come down from that. You'd see the reversal start to happen in the TLT and the TNX. And you would start to see that kind of get back to different levels that are more normal. But we don't have that yet. Could happen.
Yeah, that's by far that's the biggest question that's out there in financial markets is when are bonds going to find a bottom? When are bond prices going to find a bottom? When are bond yields going to find a top? So
right.
Got another one from Chalupa Man.
Well, I see. Alan says he does want to know about TLT. So I think we covered that. But Alan, if there is another question around the TLT, let us know. I mean, I honestly have been itching to sell puts against the TLT at this point. But I think we could probe into the 70s on that thing. Chalupa Man, let's see. Do I keep my fractal period at 14 no matter what? Yes, I keep mine at 14 from a consistency standpoint. If I start changing it up and trying to read it differently, then it throws off my strategies that I do. Remember, I'm not doing zero DTE or very short-term trading, at least not right now. Target 100s I've been experimenting with getting back into again, looking for the best way to do that. But frankly, they take a lot of management, and we've gotten to a pretty good groove with our other strategies that I don't know if it makes sense to throw those in right now. But yeah, I do keep it at the 14. I will look at the 9 though, from time to time, just to see if I'm at 55 like we are right now on the energies on the NDX on the 14, I'll jump over to the 9 and just say, okay, are we, is that releasing further? Are we below 50? Does it help confirm the trend? I'll do that, but I still like the 14. I still like how it plays out over the longer term, which is kind of how I'm investing anyways.
The one thing I'll bring up to further address that is last year when we were looking at this, we were going through all these big weekly swings. And then, we'd get this big weekly swing and then we'd see a bounce in the opposite direction. When I had my weekly chart on 14, I was never getting into exhaustion. It was always getting close and then it was bouncing back up. And so what I wanted to do was I wanted to find something that was going to be more in time with what the market was actually doing. And so quite honestly, we haven't changed anything since we've been in 2022. And if you look at this, where 14 works best in this type of market, where you have just long, slow, just ultra grinders. 14, you want to have something nice and slow. You want to take the noise out of the market. But the problem is when the market is all noise, you got to have something faster. So that's why I'm more comfortable with going a little bit quicker on these, and I haven't seen a reason to slow it down. I've been using 14 for the last 15 years. This is the first time that I've had to actually go in there and speed things up because the market's just faster now. And I think a lot of this may have to do with zero DTE.
You're also not selling high probabilities 3 to 6 months out either.
Yeah.
Or, even on a monthly basis, you're going max 45 days with low probabilities. And so what I found is that the 14 seems to work fine for the way that I trade and those strategies that I do. If I was doing, again, if I'm going to get back into doing target 100s, I'll do those off the 9 because of the way things move.
Yeah. Notice that on my monthly chart, I'm still at 14 because I don't need that. I don't, it's still a very linear. This is on a monthly chart. This is still a very linear. It's not choppy, but when you get down to the weekly and the daily chart, they are quick. So I guess what we're seeing is Chalupa Man. This is just a difference in style, and everybody needs to find their kind of one thing that you can believe in. So that's a good example of why Dave and I both do what we do.
Mm-hmm.
Okay.
Frankly, from a target 100 standpoint, I mean, when I do those, I do like one trade a week. You're doing them every day. If somebody's really interested in that short-term trading close to, zero DTE, and we've got some exciting news actually coming out about zero DTE later this month, they should sign up for your service and follow you on a daily basis. I mean, honestly, that's where they're going to get those trades every single day. So it's worth it.
Yeah, we roll up our sleeves and we slug it out with the market every day. So, all right. Any final questions before Dave and I fly the coop here? And we will obviously we'll see you guys next Monday. Usually we do these on Mondays, but we love taking questions. We love interacting with you guys out there. And so, hey, Wendy, awesome. Thank you. I'm
Thanks,
glad you like it. So I guess it looks like we are terminated here. So we'd like to thank everybody for joining us here today. And, like I said, and like Dave said, I think within a week or so, I think when we come back here in a week or so, we're going to have a lot more clarity as to what's going on, and that'll be good.
Yep.
But keep your options open on this. Wake up every morning and look and see what would I do if the market went up? What would I do if the market went down? You never want to get that deer in the headlights thing where you just get all bought in on one direction, because that's where that leads to. All right. Thanks, folks. We'll see you guys in a week. Take care, everybody.
Take care.
Adios.